Now let's do a little IRA 101. So, IRA basics. First and foremost, tax advantages, right? So people use IRAs for tax advantages, either to defer current taxes or to get rid of future taxes, to forego those future taxes. And so individuals may put money into IRAs in order to do those types of things. Additionally, they will allow your money to grow with no taxes and no capital gains tax. And that can be a really advantageous thing as well. And there are three major types of IRAs. So there's traditional, there's Roth, there are rollover IRAs, and then there's SEP and simple, and those are some lesser known, lesser used types. But we're going to focus a lot of our attention on traditional and Roth, and then rollover as well can play a part. So what the traditional IRA does is you put money in that is pre-tax money. So you may actually put money in that is after tax to you, but you will get a tax deduction based on what you put in. So it turns it into pre-tax money. And so you put in pre-tax money, it grows tax deferred, so you don't pay any taxes on the growth. But then once you go to pull the money out at retirement, then you have to pay your income tax rate on that money. Roth IRAs, however, you put in after-tax money, and so there's no tax deduction today, but you put in after-tax money you've already paid taxes on. It grows tax-free, and then the distributions or the withdrawals are also tax-free. So it allows you to have tax-free money in retirement, which can be extremely useful as well. That's why I like Roths a lot. Also, there's the rollover IRA, and that is going to be when you have a different IRA somewhere else, or you have a 401k or 403b or some kind of employer-sponsored plan that you can roll into an IRA, and you can do that through a rollover IRA. So then what about putting money into these accounts? Well, with a Roth or traditional IRA this year, 2020, you can put up to $6,000 if you are below the age of 50. If you're 50 or older, you can put another $1,000, so you can put $7,000 annually into an IRA. And what a lot of people don't know is, let's say just one spouse works and the other doesn't, or the other one doesn't make much income at all, then what can happen is the spouse that is working and that's making money for the household, they can fund a Roth or a traditional or whatever for both spouses. So if the contribution limit is $6,000 annually, which it is currently, that means you could put up to $12,000 a year between you and your spouse into IRAs, which can provide really good tax advantages for you. Now, in order to contribute, you must have some type of earned income, which is why I brought up the income thing with the spouses, because even though the one spouse may have no earned income, if they are a married filing jointly household, then the other spouse can contribute for them in their name, even though they don't have earned income. And you can contribute for a particular year up until tax day of the next year. At least that has traditionally been the way that the IRS allows it. They'll allow you to contribute up to that April 15th date has been what it is. I know it was in July this year due to the COVID-19 stuff, but just know that you could, up to tax day, typically contribute to an IRA for the previous year. And you're not required to contribute consistently to an IRA to keep it. You cannot contribute at all and have an IRA, and that would be perfectly fine. There are some very simple age restrictions on IRAs as far as when you can contribute. You can't continue contributing to an IRA if you are not working, if you do not have earned income. And so that's we talked about that. You have to have earned income in order to contribute. But age doesn't necessarily play a factor until you get into required minimum distributions, and we'll talk about that moving forward. Now, contributions for Roth IRAs do get phased out if your income exceeds a certain limit, and so just be aware of that. So for the current year, they start to be phased out at $124,000 of income for an individual and $196,000 for a couple, and that just begins the phase out. That doesn't mean you can't contribute anything. That just means you can't contribute the entire amount. And so make sure you check out those income limits before investing in an IRA. Also, traditional IRAs, they have tax deductions, like I said, right? Well, those deductions are phased out as well. But those are dependent on income and your coverage by a retirement plan at your job. So both of those things are taken into account there. So you may not be able to get that deduction that the traditional is offering. And so it may not do you the most good over the long term if your income is too high. So let's talk about distributions. Well, distributions from an IRA cannot happen tax-free and penalty-free before age 59 and a half. And so 59 and a half is the point at which you can take money out without penalty, and that's from either a traditional or a Roth. Now, these distributions are not required ever unless it's in a traditional or rollover IRA. So for a Roth IRA, there's no requirement to take a distribution. You can just leave money in a Roth forever and allow it to grow if need be. But for the traditional and the rollover, what you have to do is you have to take required minimum distributions. You may see RMDs at age 72. They've actually bumped that up now. It used to be 70 and a half, now it's 72. And what that is some percentage of the amount of money that you have, and it's on an increasing scale every year that you have to make sure that you take out of those accounts. Basically, it's Uncle Sam wanting his money, right? You haven't paid taxes on that money yet, and they want to make sure that when you pull money out of the traditional, and like I said earlier, that incurs personal income tax, then the government will get their money, the IRS will get their money. And so that's just a particular rule that they have. But with the Roth, there's no issue. You don't have to pull money out ever if you don't want, because that money's tax-free afterwards. So why would the government care? Why would the IRS care to get their hands on that?